Hey everybody, it's Pete. Good morning. Welcome to a new episode of Stocks for Breakfast. Today we're going to talk about the good old days versus the the kind of market that we have today, and accepting the fact that the markets always change. Now, one thing that doesn't change, however, is money management, and that's actually understanding, sticking to, and excuse me, what we call in the boot camp is respecting your risk, respecting your stop loss, and never moving your stop loss. One of the things that we talk about, and I have been talking about for years, is the difference between taking risk and accepting risk. I usually start out seminars where I talk about, are you accepting risk on every trade that you take? And everybody's hand goes up, and most people are wrong. There's really no other way to put it, because you might say that. However, I'm gonna absolutely prove that you're one of those people that I would fool or trick, get with this trick question at a seminar. Because raise your hand right now if you've ever moved your stop loss. So price is pushing down, getting to the spot where you said, that's where I'm getting out. And then as soon as it gets right there, you're like, I'm going to cancel it just for a minute. So that means that you took risk. That doesn't mean that you accepted risk. Accepting risk means I'm going to risk $500 on this trade. And if it gets down there, I'm getting out and then I'm going to the next trade, because I've accepted the fact that in exchange for the potential profit on this position, I'm okay with getting out because I know I'll make it back on the next one or maybe the one after that. But this is a reasonable loss within my business. So you need to always have in your mind, I'm accepting risk on this trade. I'm accepting a certain dollar amount of risk on this trade. So what does that have to do with the good old days versus the market that we have today? First off, it's a question that I get all the time. Is this a good time to start learning how to be a trader? I want to answer this in very clear terms. This is an amazing time to be a trader right now. This is an amazing time to be involved in the market. And if you're struggling right now, it just means that there's pieces that you're missing. You probably understand everything about charting, but you don't understand how to make money yet. I've got to tell you straight up, charting and making money are not the same skill. And that's really where a lot of traders get frustrated, because they think they know everything about what it takes to get paid, but you only know how to chart read. Chart reading and getting paid and managing your emotions and managing positions and managing losers and managing winners and all of that stuff, the stuff that happens between entry and exit, the stuff of building an argument, that's not chart reading. That's the next level past chart reading. Chart reading is kind of like you're passing your road test at motor vehicle by taking the written part, but you haven't actually gotten out in the car. And even if you do get out in the car and pass the test, then you need to drive in the rain and the snow and traffic and stop and go and all of that kind of stuff. And that's what we specialize is mentally getting you ready and repetitive. Here's what to do. Here's what to do. Here's what to do. Here's what to do. So again, what does that have to do with the good old days versus now? Well, I'm going to show you an image, and then I'm going to come back to the screen because it's kind of interesting. I found this in a old trading book that I have. And the guy's name is Dave Landry, who I followed way back in the early 2000s. And it's the good old days of you would see a stock pull back, you put your stop loss here. We call this a swing low, right below that swing low. And yay, smiley face, it just goes straight in your favor, right? Now, here's today. Same exact trade, two candles later, you get stopped out, and then the chart does, kind of exactly what you thought it would do, right? And I guess Roku here recently, which has been on fire, we've been trading this pretty much every day in the boot camp. You get this large range candle, you get involved, and the breakout pulls back, takes you out by a penny or two, and then explodes and does exactly what you thought, but you were no longer in the position. So what do? You have a lot of people out there on YouTube and social media and a lot of places like that say, here's the spot, get in on this spot, and you can only risk 10 cents, get as many shares as you can, and as soon as that sucker moves in your favor, you're going to clean up. What they don't tell you is the amount of times that you get these wiggles and jiggles back and forth where everybody else on the planet seeing the same exact thing. Something else I want to point out, get out of your mind that they are out to get you. They know where your stop loss is. They're going to take you out. That's complete horseshit. Don't do that. Don't have that mindset of they're out to get you. Sure, maybe if a stop loss is at the exact low of the previous candle, maybe you're going to get taken out, because if there's a bunch of stop orders there, the odds of it hitting that, the odds of, not they, the odds of it hitting that price are pretty good, but get out of your mind, they're out to get me. So here's the thing. You can put on a lot of share size and say, okay, if I get this trade off and it doesn't stop me out, I'm going to be up a lot of money very quickly. The problem is it's just not reality in today's market. There's algorithms, there's Robinhood, there's the market changed. We don't have market makers and specialists physically standing on the floor managing all of the order flow that goes back and forth. Now there's a lot of noise in the market, a lot of noise. So what do you do? Well, first off, if you have that frame of mind where you say, all right, I'm going to get in there with size, and when these trades work out, awesome. When they don't, I'll just take the loss. And that sounds great on paper, but the reality is most people don't want to take that loss. And I'll give you an example. We'll use Tesla as an example. There's a lot of people this year and newer traders in the boot camp who were trading size in Tesla who had absolutely no right in the world to be trading size. And they were right one trade, right trade number two. And now they have this mental model of, well, if I just keep trading size, Tesla's just going to keep moving in my favor. And then one trade wipes out their entire account because they didn't have the discipline to get out. So part of trading that size, if you believe you can perfectly time your entries, part of trading that size is the mental fortitude, the mental discipline, the strict rules on, I'm getting out here no matter what, because I'm not going to milk this position with size against me. But I'm going to tell you straight up, most people don't have that discipline. Most people don't want to be wrong. Most people put on trades expecting fully to be right, don't accept the risk on the other side of the trade, and then they sit there milking a position. And the worst thing that happens is Tesla goes into a trading range for a couple of months, and then 2.5, 3 months later, as it just did, it exploded, went to new highs. Now that person, that unfortunate person, is now sitting home saying, see, I was right. No, you weren't right. You were trading poorly because you were trading too much size for your position, and you didn't have discipline to get out if the trade didn't work in your favor. And now that's a whole lot to talk about, right? But it doesn't have to be that hard. That's the point I want to make in this entire video. Share size and trade management, the smartest traders, the longest lasting traders in history, don't take full share size on their initial trade. Now, look, if you're like me, like when I first started trading, I wanted to make as much money as possible. But you don't need to trade maximum share size. And we kind of shared this with our members of our community recently, where it's one of those things where we had a conversation. The conversation started when I was like, yeah, I guess I take that for granted because it was something I did years ago. It just became a part of how I look at all of my trades. Now, again, the time frame you're trading matters. Now, it doesn't matter if you're day trading or swing trading, but it matters within the context of how much volatility is available that day, how much the stock normally moves that day, that week, and that month. You need some room for the stock to go. And that's most professional traders. And I came from the proprietary trading world, which means you traded for a firm, and I owned a firm at one point. Most prop traders build positions. Now, whether it's in 2 pieces or whether it's in 5 pieces over 2 weeks, looking for that bigger move, what we're generally looking to do is we're looking to get a head start on a trade. And essentially what it is, some people call it a tier 1, some people call it a probe, whatever you want to call it. Most professional traders don't go all in on their first entry. They're looking to go in for a piece of a trade and looking to get a head start. And think about what the math does on this. The math basically says you can now allow the stock to breathe just a little bit. And I'm not saying don't take the stop loss, so please don't take it out of context, but you have a smaller initial position. You're letting the stock do the normal noise that goes on in the position. If it continues to move against you, whatever you decided, whether you're getting out of that trade, you're losing on less shares. But if you get a head start on a position, starts to move in your favor, now you are making money and you could add to that position. So we call it feedback. You're basically getting feedback from the market where the market is saying, nope, not yet. Or the market saying, yep, there you go. So if you think about the math, you will have the most shares on winning positions because you're only adding on trades that are working out. And when you lose, you won't have big losses. You'll have reasonable losses, but you won't have big losses, especially on your initial entry, which here's the key to what I'm getting across. It will allow you to not hesitate on your next position because you're not going all in on the position. The only time you should be sizing up, and I want to touch on this in a second, you're not going all in on your initial entry because you think you're right. You built as good of an argument as you possibly could, but we could still not make money on that trade. So we put our best educated argument out there. We look at the market, we look at the sector, we look at the industry group, we look at the last couple of days, we look at is the stock well bid? How long has it been well bid? Then we put the trade on, right? Now, I want to get out of your head because I can already hear it and feel it because I'd be thinking the same thing. Is well, I want to make bigger money. How do I, I don't want to trade baby shares. First off, what I'm talking about here is getting you to the point where you're getting in the habit of forcing the market to give you feedback. That's what you want. Feedback. Tell me if now is the time. Tell me if now is the time. And if it starts to move in your favor, great. I'm not saying trade 100 shares, although that's what most people should do when they're first learning because you want to keep the cost of your learning curve lower. You could still trade your initial piece, your tier one, your probe with bigger shares as you get more experience. So whether your first piece is 100 shares or your first piece is 1,000 shares with the intention of adding 500 and 300 after that, your initial share size is going to be dictated by two things. First off, always have probe in mind. First off, always have in your mind, I'm letting the market tell me if it's time to get in a little bit bigger. Second is if you are trading, really fine tuning your entries and you get to the other side where you are flawless in your execution of your stop losses. If you have a really defined risk reward parameter where I'm risking $1 and I clearly see $4 that I could make on this trade, and you're disciplined at getting at that, then you can actually size up a little bit more on those initial trades because you have a super finite risk point and you've proven you could flawlessly get out there. This is a little bit more day trading or faster swing trading type of thing. But if you're building positions and you want to hold those trades a little bit longer, then you want to really be probing on most of those trades because it's also, especially too, because you have that overnight risk where you could be right and then all of a sudden something comes up and it gaps against you. So the differences between day trading, swing trading, position trading, that should be a part of your trading plan to dictate how you plan to get those positions. Intraday on a day trading basis, there's, depending on the stock you're trading, maybe one extra entry after your initial entry, maybe. If you have a really good market, a really good trend, order flow is clear, the tape is easy to read, volume's good, the market internals look good, you can probably go in with a little bit more share size. But even if you go in with more share size, which is kind of an advanced thing that I'm about to mention, you can go in with a little more share size, and if it moves against you a little quickly, because we're practically trading with no commissions now, which is crazy, another great thing about trading in today's market. If it moves against you a little bit, you still love the idea. Let's say you have 1,000 shares. You can always take off 500 right away if it's moving against you. And that's not trading scared. That's trading, managing risk. Our job is risk managers. Our job is managing risk, probabilities, leverage. If it pulls against you and it doesn't really cost you anything to get out, and all you're doing is lowering your risk, lowering your exposure, as long as you're at your seat and you're day trading, you can put those shares right back on. So as soon as you get out of that position, or as soon as you scale back out of that position, you set an alert or set a buy stop to get right back into those positions as well. So really the point that I want to get across is the good old days versus today. There's amazing, amazing opportunity today. But all I'm asking you to do, if you're watching this now, probably 6, 7, 8 minutes into the video, that means you have a burning desire to understand how to do this. So give yourself a chance to gain market experience. Give yourself a chance to learn the difference between chart reading and tape reading and reading the market and being a trader. Chart reading is not trading. I just can't stress that enough. And look, if you want some help with that, click down and learn about the bootcamp. If you want to keep learning it on your own, that's okay too. But I just can't stress this enough. You need to trade to learn how to trade. And the smartest way to do that is the first system that a lot of people talk about over the years, which is putting out a probe, getting feedback from the market, and only then getting size. And you gain your experience as a trader, you'll know how much that initial probe should be. You'll know how much that initial share size should be. And also it depends on how far and how far that stock could move in whatever time period. If it's a day trade, what does it normally do? Which is another consideration. If the stock normally moves $2 and it's already gone to $1.50, probably doesn't make sense adding the second piece. So all of these kind of things are really what you have to factor into your trading. So I thought it was kind of fun to discuss the good old days versus today. You probably got a little more noise now, which means you need to adjust as a trader and work those positions a little bit until you get the mental discipline to be like, I'm flawless in my executions and I could be a little bit more aggressive on my initial piece. And you'll learn when there's different types of market conditions, when you should only be looking for probes, which is probably much wider volatility. Or if the market is slowly grinding higher, then you can maybe get a little more size because it's clear it's not reversing and the volatility is not that high. So there's a lot to consider, but this is an amazing time. All I'm asking you to do is give yourself a chance to learn. Again, if you want to do this and you want to make that extra monthly money that we're all after, give yourself a chance to learn first, then understand how to size up a little bit, and you'll be thankful that you did. Have a great day.